Hi guys, this is Mark McRae, and we're going to finish the week by talking more about financial ratios, and this is in our quest to become more financially literate. So I'm not an accountant, but over the years I've learned how some numbers that are important to me work, and they might be important to you. So let's look at this one, this debt to equity ratio. So the debt to equity ratio is a financial ratio that measures the amount of debt a company has relative to its equity, and is calculated by dividing a company's total debt by its total equity. It's normally done on a yearly basis. So let's say, for example, that you had $20,000 worth of liabilities and equity that you have is $100,000, then that ratio would be 0.2 or 20%. So why is that important? Because as an investor or as somebody who has put money into a company, you always want to know that you have more, you have more equity than you do liabilities. Because if you were to close up shop straight away, you might have to put money in. So let's have a look at the next one. Interest coverage ratio. So the interest coverage ratio is a financial ratio that measures a company's ability to pay its interest expenses on its debt. The ratio is calculated by dividing a company's earning before interest and taxes, EBIT, by its interest expenses. So if you took the EBIT and then divided it by the interest expenses, that's going to give you your coverage. So let's say that you had EBIT of $1 million and interest was $200,000. So your interest coverage ratio would be 5, right? So 5 times the interest that you have to pay. And one of the reasons that this has to be paid attention to is if you've got any kind of debt, how's that debt increasing? Right, so you might find, for example, that interest rates are rising, the type of debt that you have and the interest that you pay on it rises with it, then coverage becomes very important. Next, we'll have a look at debt service coverage ratio. So similar to the interest ratio, but only we're talking about debt itself now. So the debt service coverage ratio is a financial ratio that measures a company's ability to make its debt payments. It is calculated by dividing a company's cash flow from operations by its total debt payments. So, it's different because you've got debt, right? So you have principal and interest. So you've got to figure out, your debt payments and interest payments, you've got to figure that out. But if you looked at just the debt payments, then it would look like this: net operating income divided by total debt service. And that is going to give you a ratio. So again, you're looking for that ratio to be above 1. But if you were in mergers and acquisitions, you're going to look to see how you can cover that, and the higher the number, the better. I have seen businesses over the last few years that had a debt coverage ratio of 3 and 4, and that has been declining. And now, anything above 1.5 seems to be good. But also a number you have to pay attention to if you have debt. I hope you've found these tips of interest, and if you like them, go to YouTube, look for Mark McRae, and subscribe, like, give me a thumbs up, and I'll continue to do them. Thanks for listening.